Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 26, and we're going to continue on this combined subject of raising funds as well as distressed properties. And as you remember, in the last episode, we sort of left off on leveraging the same example, starting with distressed property that turns into a flip, and using one of our trainer and mentors, DL Jeffries. And today we're going to use the same deal and walk you through the entire BRRRR process and how you actually can speak to that with your potential OPM. And so I'm going to continue using my cousin as an example. So here we go. I'm going to first thing first, pull back up our little slide here, and that way we can follow along and have that continuation, okay? And so let's see if I can find my screen. There we go. Okay, so I am hoping that you can all see this at this point. And example for Jeffrey, I'm just going to fast forward through all of these numbers now so that it refreshes your memory. And so I know one of the things that we always get asked is that so many different presentations and so many other webinars we go to, they're showing purchase price of $300,000 and $400,000, and it's just not applicable anymore in today's markets. And this is why I always say that at Trust Your Talent, the mandate, one of the biggest mandates for all of the trainers, mentor, and coaches is that we are all walking the walk. We are all active real estate investors and business owners so that we keep our fingers on the pulse in terms of what's happening in the marketplace, whether it be regulation changes or rate hikes and what it means to us as investors. And so some of you guys may have noticed that even though there wasn't a Daily Dose episodes over the weekend, on Saturday, there was actually a special webinar that I started. And this episode, for our Canadian friends especially, I started out with understanding all these letter programs that real estate investors can potentially leverage rather than from simply just a first-time home buyer's perspective. Because a lot of these government programs really are designed for first-time home buyers. However, as educated real estate investors, we always look for what we call relevant information, because information is a dime a dozen these days. Everybody's got a cell phone, everybody's got access to the internet, and these days we even have AI now explaining things at our fingertips. And so it's really funny because I used to work the Yellow Pages. So apparently the tagline was "Let your fingertips do the shopping" or something, do the walking. Anyways, the point is, here I want to share something with you that you can still find in a lot of the different markets across North America. This is a very, very real example. And in the previous episodes, I already explained the fact that distressed properties not only is a fundamental strategy, it is one of those strategies where it's applicable in any market. Yes, certain economic conditions will present a bit more challenges. However, again, when you're educated, you don't care if the market's going up, down, or sideways. You are able to capitalize on opportunities and different conditions, not people. I want to really make sure that everybody understands that. Okay, it's never about taking advantage of people. It's about being able to solve problems for them and taking advantage for the situation. And I'll take that one step further once again, is the fact that when we wake up this morning, sellers need to sell, buyers don't necessarily need to buy, okay? I want to make sure that everybody understands that when you're leveraging real estate as your main asset class. And so at this point, I want to quickly walk you through the BRRRR process one more time. I know we've got a couple of previous episodes talking about this already. So I want you to really marry the different components of the BRRRR process. And here, I just want to be a bit more technical with everybody in case this is your first exposure, because I understand that most of these videos are being consumed after it's been broadcasted live on Facebook, especially. However, I want to be very, very clear, because part of what I got to do sometimes is to make sure that everybody is on the same playing field. Okay. So again, the BRRRR model or the BRRRR process It's not a strategy. Don't forget, okay? It's a systemic approach to improve a distressed property so that we are able to add value, force the appreciation. And as a result, when we're adding value to the property, typically speaking, when you are putting the product back on the market, it is going to be able to garner you higher rent, meaning hopefully at the end of the day, after all is said and done, better performance, okay? Better performance on this particular asset. And if you wish, depending on when you would like to do the refinance process, remember, cash out refinance for my American friends is what you call it, cash out refinance, so that you determine how much money you can and need to pull out of a performing asset so that you can duplicate this. I know some of us want to run a lot faster, so you might be, that process might be a little shorter for you. Some of you might actually wait a year or two, especially if your building type is a lot bigger, okay? Right now, we're simply leveraging single family home, a single family home example to demonstrate the principle. However, as you go bigger in your property type, there may also be lending criteria that will restrict you in terms of how much funds and equity you can actually pull out if you don't satisfy a certain timeline criteria. Okay, I want to make sure that's very clear. And if it isn't, here is the plain and simple version of it. Again, ESL, English is not my first language, so I like to keep things plain and simple. What that means is, for example, if you have a larger multi-family building or multi-unit residential, as we call it, there's a difference. Once again, if you go back to previous episodes, many a times in Canada right now, especially, you will have lenders that will say, we are not going to count the forced appreciation. So the forced value add until after 2 years and until you've got proven track record. Why? Because most lenders know once they allow you to take out the money, the equity, that means typically speaking, your debt servicing goes up because you're owing more money now. And what that also means is if you remember the income property, the high level income property calculation, when your debt servicing goes up and you have very similar NOI, net operating income, then your cash flow is going to go down. So cash flow going down is not a bad thing for as long as you can continue to scale and put that money into a new deal. However, you also need to consider it from the lender's perspective so that you don't really run into surprises for yourself, okay? And so at the end of the day, it's up to you to decide whether or not you want to repeat the process, meaning you take the money out, you go into a different deal, or you basically keep that as operating revenue. Remember, during one of the episodes, I discussed briefly about how the rich and the wealthy create the most legal tax and income shelters for themselves simply because they understand how to leverage debt and they understand taxes and how it works. So in this particular case, you may choose not to repeat, okay? And so this is something that we've already discussed in the previous episodes. And so here are the 5 steps once again: buy, renovate, rent, refinance, repeat, or cash out, refinance, and repeat, or money in, money out, asset for free or asset for almost free in different cases, and income for life because you're going to continue to cash flow from it. And so to really solidify this, 4 ways to make money in a BRRRR process. Remember, educated investors, we make money when we buy, okay? We make money when we buy, not when we sell. That's what amateurs bank on. And sometimes they don't even get to do that. Right now, I know a friend who are living in Toronto, who's living in Toronto. 4 years ago, actually, no, I think this is 5 years ago now because they took possession last year. 5 years ago, they bought into a pre-construction condo in downtown Toronto for nearly $550,000. It is a simple studio. It's a simple studio for under 500 square feet. And they pay $550 to get into it. With closing costs, taxes, and everything else, after all is said and done, they ended up last year at closing having to come up with an additional almost $100,000 to close, meaning they basically put in at $650,000 almost to acquire this property. Now, the good news is fair market rent, fair market value. Fair market value for that property right now should be around, based on comps, should be around the $700,000 mark, if not a little bit more. So now we're thinking, yay, that's awesome. However, again, if you flip that now, okay, having been living there for another year, so they basically they avoid a lot of the implications when it comes to taxation. That's their choice, not mine. I wouldn't do that myself. However, that's what they choose to do. And so after 1 year, if they were to sell it, let's just say they sell it for $700,000. Well, $700,000, when you commission a realtor, that's 5% right there, plus the sales tax on top. 5% tax on $700,000 is $35,000, plus the 13% sales tax. Here, you're basically looking at another $5,000. So after all is said and done, basically the take home is likely about $660,000. Think about it. 5 years ago, they put in $650, okay? And then now, if they do flip it, they make $10,000. And that's assuming no legal fees yet. That's also assuming there are no other fees in between that they would have to take care of. And as we all know, there will be moving fees and cleaning fees and setup listing fees. Sometimes maybe you even have to stage it so that you're able to get top dollars. Regardless, the profit margin is so small, and you've just burned 5 years of your time. Again, I'm not picking on my friends because they've now since learned the error of their ways, to be completely frank. However, let's put it this way. The reason why I'm sharing that example is also because they just recently shared with me that they're not even going to be able to make $10,000 even if they wanted to. Why? Because the builder apparently did not sell out the units, which honestly, also to my surprise, because I thought everybody, every single undereducated or uneducated amateur investor or property buyers were buying up downtown Toronto condos like they're candies. Okay. Turns out the builders had 4 vacant units that they've been hanging on to for the last year. And now all 4 units, same units, basically, same layout, same size, just on different floors. And he's listing them, the builder's listing them at $599 a pop. So I want you to think about that. In single family homes, that's one of the biggest things that we face. And that's why I really highly encourage you to go back a few episodes, okay? Or really, better yet, if this is your first episode of My Daily Dose with Tim, please start with episode 1 of this season so that you can really catch up and connect the dots for yourself. Because I've already discussed with everyone why we do not buy anything pre-construction, first of all. Second of all, we do not buy condos. Okay, so coming back here now, we buy under fair market value and we get to renovate to add value so we can force the appreciation. And as a result, we get to improve the property's net operating income and initially the cash flow for sure. If you don't get to do that, it's probably not a good BRRRR. Okay. And at the end, refinance to take out the equity, and that money is tax free. Why? Because it is debt. You do not get taxed on debt. So going back to the Wheel of Wealth a few episodes back, remember, that money, even though it came from your equity, but because you took it out in the form of debt, it basically now does not fit into any of those income buckets. Okay. And as a result, it is tax-free. And so moving forward, we're going to leverage the same concept and a different numbers now. So I want you to understand that even if we were to use the $720,000 property, it would still be the same thought process. Once again, it has nothing to do with the property and how much they cost, because educated and professional investors, we don't focus on cost. We focus on the return. Okay. It is never about how much is it going to cost me. It is always about how much is it going to make me. And at the end of the day, your personal situation is going to dictate whether or not how much it's going to make you justifies the time, the effort, and the resources you will have to mobilize to get it done. Okay, and this is why it has nothing to do with the deal. Remember, the most profitable, the best income generating asset is not a property, it's not a stock, it's not a company, it's simply the level of financial education that you have. Okay, so now let's take a different look using the exact same formula and the exact same format that we've been using over the last few episodes now. This is the deal on the table. Purchase price at 235, appraised value at 270 already. So there's money in the buy, $35,000 right there. However, remember, when you are leveraging traditional lending, the lenders will more often than not, if not 100% of the times now at this point, will lend to you based on either the appraised value of or the purchase value, whichever is lower. So in this case, you're going to use the 235 number to get this mortgage. So after we factor in closing costs, down payment, and the reno, including holding costs, we are in it for an initial investment of $125,000. And after all is said and done, the new fair market value is $350,000. We get to take out a loan to value of 80% mortgage. Okay, we're now at the basically tail end of BRRRR. Okay, we've bought it, we've renovated it. Okay, I'm going to show you the performance in a bit. So we're renting it out. Now we pull out based on a refinance 80% against 350. Okay, we pay ourselves back. That means at the end of all of this, the money left in this particular deal is $30,000. And let's take a look at the performance. And FYI, in case you're wondering, this particular deal was also done at the beginning of 2022. So this is all quite relevant in today's markets because yes, even though at the beginning of 2022, the rates were low, however, the values were high. And now we're starting to see the transition because if you're in Canada, like me, then you know that the Bank of Canada actually raised the overnight rate again, which means interest rates, most banks have just raised them on Sunday. Okay, actually, no, last Friday. And so as of today, the rates have gone up again, which means it's now deterring amateur buyers to really get into the market, which means it will also force amateur property collectors to start to unload inventory. Okay, and so this is where the opportunities really come in. And so here are the performance numbers for you to look at. So on a monthly basis, it is cash flow of $720 per month. Okay, from a raising funds perspective, let's just say that you promise your cousin, in this particular case, a 50-50 split. Okay, after all is said and done, they've got their initial investment paid back. And you've decided to split the 720, 50, 50. That means you each get $360 per month. Okay, $360 times 12 months. So they're getting $4330. Okay, $4330, $4,320 on an annual basis, divided by money left in a deal, assuming that your agreement is that they keep their money. Okay, they keep their money, none of yours. So 30,000. That means an annual cash on cash of 14.4%. Okay, not making this up. This is all just straight up numbers. This is all straight up numbers. So let the numbers do the talking. I know some of you are going, well, that's basically just, if you already got the deal cash on cash of 28.8%, that's really 50% of it. Yes, however, I wanted to walk you through how that came about, okay? If you want to be very technical about it. And so with that said, think about it. You now can speak to this deal with your cousin in this case and say, you know what? $30,000 is left in the deal. And now they've got 125 back. How many more of these types of deals are they willing to do with you so that you can continue to add 360, 360, 360, 360 every single month for them? So assuming you do this for them 4 times, 4 times in a year. That means within the first year, you have added $1,440 a month for them in passive income. You've also added the same amount for yourself on a monthly basis, and they may not be your only money partner in this case. Maybe your other cousins want to jump in. Maybe your best friend wants to jump in at this point because you got a couple of track records now. Maybe your parents will jump in. Okay. So this is why I think so many people, they forget to really truly look at just focusing on one good deal at a time. There's a difference between getting your first deal done and getting one solid good deal done at a time. Okay. And this is why it always puzzles me when people are more drawn to ads like get your first deal done in the next 90 days versus create the financial success that you deserve in the next 2 to 5 years. There's a fundamental difference there, and I hope that you're starting to recognize that, having gone through this many episodes of my daily dose with Tim with me now at this point. And so with that said, I will come back here in the next episode to share more with you in terms of how I would actually typically go in a deal like this and speak to it with my potential money partner. So on that note, I just want to say thank you so very much again for joining me today on this episode. And make sure if you got any questions, you got any comments, you got any feedback for me, you put it in the comments section below or DM me directly. And I really, really do appreciate it when you share these episodes with people that you think need this. And I believe that many, many of us are truly thirsty and hungry for financial education rather than just focusing on real estate investing. That is the vehicle. Okay. I'm not saying it's a bad thing. I'm just saying it's not the first thing that you do. And so hopefully all the episodes are helping you out. And I appreciate your love, your support, and your encouragement and your engagement more than anything else. So have a great rest of the day. And today is Monday one more time. And I'm always, always super excited about Monday because I feel like it's one of my most charged and most productive days, usually every single week. And so on that note, enjoy the rest of the day and have an amazing, productive week. I will see you back here in the next episode. Live well, everybody.